Hi everyone, and welcome to this webinar today with Forrester and Onfido. Today we're running through with a panel discussing the topic of best practices for applying and scaling KYC. Now, I'm joined here today by two wonderful speakers. Joined here by Yuelin Li and Andras Cser from Forrester. I'll leave them folks to introduce themselves in a moment before we dive into the topic at hand. But just so you're aware, today I am your moderator, Alan McAlpine, and I work as a Director of Product Marketing at Onfido. And before we dive into the meaty topic for today's conversation, I'll let Yuelin and Andras introduce themselves. So Yuelin, over to you quickly.
Great, thanks Alan, and hi everyone. I'm Yuelin Li, I'm the Chief Product Officer at Onfido, which is a real identity company.
And this is Andras Cser. I'm a Vice President and Principal Analyst at Forrester. And I cover AML, KYC, and fraud management. I'm very happy to be your guest speaker today.
Wonderful. Thanks for joining, folks. And so everyone on the call, over the next 25 minutes or so, we'll be running through some panel questions just to get discussions on the topic of KYC. But before that, let's try and get everyone on the same page. Now, we have a lot of discussions amongst the team in terms of where we're at across the KYC and IDV market. So to get everyone across all of the industries and all of the guests aligned here, here's roughly what we at Onfido have been seeing in the market and what the snapshot is for the year that was in 2022. So the big change we've seen in the market really has been, I guess, the changing of regulatory scopes. So you've seen things in the EU and US and further afield changing the scope of KYC AML. For example, crypto has come under a microscope. You saw Biden's executive order on that. You've seen the EU recently folding crypto more into the KYC realm. We're seeing the KYC market rapidly evolving, rapidly fragmenting, and being pulled back together again. That is something that is perhaps going to continue a lot in 2023, but we'll find out from the panelists in a moment. We've seen a really big topic coming to a head again, really, on this ongoing tug of war, as we call it, of UX, fraud, and compliance needs. We see people on the one hand trying to look at producing better customer experiences, reducing friction, adding less relevant, more relevant signals into the KYC experience. And you see teams start to have more of a holistic view of what the compromises being made are. And so more than ever before, there has been this tug of war really coming to a head and people being more mature in the market on it. On the flip side of this, you also see a need for what we're seeing for orchestration or some other solutions whereby people are going less from I need to signal into more of what we might call journey time orchestration, which would be a real manifestation of this notion of trying to balance off how to get a customer through experience, but also trying to toe the line of fraud and KYC needs. And the third trend we've seen really is, I'm sure if there were a word of the year for 2022, it probably would have been market downturn. Broadly speaking, there have been market headwinds creating a lot of uncertainty within the financial services market and beyond. A lot of need for folk to get more thrifty, and we suspect in 2023 this will continue, with growth rates declining for many businesses, costs rising, and so a reduced focus, or rather a renewed focus, on the bottom line and how to create cost efficiency within that. And these are three key trends that we've observed at Onfido based on our market analysis. But with that, I want to hand over to the team, the panel, to really run through some questions around these topics. So what surprising changes have you, Andras, Yuelin, seen in the local and global KYC regulations in the last few years that are perhaps noteworthy for this conversation? So I'll hand over to Yuelin if you would like to start first there.
Thanks, Alan. So definitely think the theme of fragmentation is a good one to describe what's been going on in the world. So although overall on a global level, there are KYC themes, the way that this has been interpreted at a regional and domestic level has resulted in a huge amount of fragmentation, which has made it much more complicated for companies that work on an international basis. And I think some of it may be a bit more expected, such as like some of the fast-growing emerging economies or digital fast countries really leapfrogging and creating very sophisticated identity systems, to some which I think have been a bit a bit more unexpected, such as the US, like post the Equifax hack. I think there was a lot of expectation that there would be momentum to do more with identity verification and KYC. And actually, to do lots of different reasons, some of which political, the market's actually moved a lot slower in the US now. And if you look at compared with many other countries in the world, it feels the administration is playing a bit more catch up there. Though I appreciate that they are now moving with much more force, and it's sort of pushing this idea of identity and KYC out of a tick box exercise and compliance much more into a important driver of your business, actually knowing who your customer is, regardless of what you're planning on doing with them afterwards and what your relationship is.
Yeah, so on our end, at Forrester, we've seen a few things. I would just highlight the following points, right? So number one, regulators have gotten a lot more technical and a lot more focused on how the controls are taken care of, right? So it's like beforehand it was okay to just say that on a piece of paper, like check the boxes on a list. Now they want to understand the technical details of KYC, transaction monitoring, and the entire AML process. So that's number one. Number two, I would say there's just as Alan mentioned here, new transaction types creep into the picture, right? There's a lot more focus on peer-to-peer payments, cryptocurrency payments, new styles of real-time payments, and the whole idea here is that you're seeing a movement to real time, right? So whereas KYC and AML used to be purely reactive kinds of activities, with these newer style payments, newer style, expectations for much faster customer onboarding result in a much more real timeliness of scrutiny, right? That you have to be able to do before you onboard somebody. And then the third thing I would highlight here is the convergence between fraud management and AML and the whole compliance and fraud teams. This is also around kind of saving on labor costs, saving on instrumentation, saving on data integration, and investigative costs, right? So you're able to share the load and the burden and the costs between the fraud side of the house, so preventing fraud, identity theft, transactional payment fraud, non-payment fraud, as well as the whole AML, KYC, customer due diligence, transaction monitoring side of things.
On especially the last 2 points Andras mentioned, I think it has driven the whole industry to be a bit more dynamic in general, because if you think of how people track identity or credit scores, sometimes it takes, like, at least in certain geographies, like 6 to 12 months for your information to be accurately updated in all of the different databases and so on. But now expectations are just so different. You expect to be able to, whether it's open an account or get a loan or buy now pay later or do any of these things, and the institution also needs to be able to manage that and not just rely on this third party with a piece of data that's very static. So it's definitely driven the industry to be a lot more dynamic than it was.
For sure. And I think one thing that you both touched on really is the notion of, I guess, this increased dynamism, increased scope of regulations, but also, Andras, you mentioned a really good point here around fraud and compliance conversion. Interestingly enough, though, it looks like for many businesses, they have more things they need to do, or indeed more things they need to be aware of, which can drive up the cost or drive up the friction for end users. And with that in mind, I'm just wondering, kind of, as businesses look to reduce those costs, how can they effectively scale those KYC processes? Andras, I'll go with you because you mentioned really kind of concisely at the end there. I'd love to hear your thoughts.
Yeah, I mean, one thing, so basically following points, just number one, I would say consolidate KYC AML across multiple lines of businesses. So if a bank or financial institution has a number of lines of businesses, try to move away from this super siloed, every line of business has their own KYC team to, one central KYC team doing the work, right? So that's number one. I would also say, obviously, improving just the technology, so improving the models, right? The effectiveness and the accuracy of the models, AI, machine learning, rules-based. So it's a continual process, right? There's always things to do there, right? This is like the laundry, model improvements never end, right? And so that's, I would say, number two. And then once you enter the investigation process, using tools that help investigators come to conclusions faster, more accurately, and with less labor, including using visual link analysis, natural language processing, semantic analysis, and not only kind of structured data, but also unstructured data as well.
Yeah, I agree on that. I think traditionally there's been a lot of very labor intensive and unoptimized processes. And now there are platforms available, a lot more tools available to help people very quickly automate or reduce the complexity of some of those processes so that it's much quicker to do them, but also makes it much easier to scale. I also think there is a big element of, especially amongst the more digital transformers, we call them, which is at return on investment for a lot of this stuff is driven very much on how many people don't make it through the flow. And if you're spending a huge amount on marketing, whether your existing customers or new customers, and then bringing them into the journey, and then they don't complete the journey for whatever reason it is, that's actually incredibly expensive. And when we see ROI, it's driven a lot by less people dropping off, which is not just to do with the cost side, but actually also the revenue side. And something like having first-time success rate for your users, whether applying for your product for the first time or applying for new products, you still often, I think silo is a great word, you often still see, for example, financial institution advertising to its customers a new product, whether a credit card or a loan or something else. And then when that customer goes to apply for that product, it's actually a huge new process. They may even they may appear to be eligible, but not actually eligible. The systems don't talk to each other. Having already had one product with this doesn't necessarily translate into even being able to have those other products, but the marketing spend has been spent. And so actually, I think in this era of looking very tightly at costs, I think costs shouldn't just be the bit that you're spending on, though of course you absolutely need to make that more efficient, but also making sure every marketing dollar and every sales dollar you're doing at the beginning is actually translating into the business outcomes you want.
Andras, I'm actually curious for your view on that one as well. So I suspect obviously you spent a lot of time talking with businesses who are looking to navigate this. Do you feel like there's an awareness of cost being a function of how much am I spending on this, but also more importantly, perhaps how many people am I onboarding?
Yeah, I mean, there's definitely questions around, the cost of onboarding a single customer, right? I mean, this has multiple components, not just the KYC, customer due diligence, right? But other, account opening, just non-security, non-compliance related types of costs as well, right? And every bank and every, there's also non-banks, non-financial institutions, other types of verticals like healthcare, retail, insurance, right, that are increasingly interested in, and government interested in offering digital services to verified and kind of sanction screened identities. Just to kind of answer a question, right? Typically, nobody wants to spend a cent more than their competitors in the same vertical, right? That's, that is a given and a standard that has been around. Depending on the cost, right? We're seeing somewhere between in the onboarding process, 1 to 3 euros per onboarded, kind of account or onboarded customer kind of costs. And that is something that businesses can, still digest. But once these onboarding, compliance, KYC costs exceed €3 per onboarded customer, things are going to get a lot of questions, right, internally. It's too expensive. It's it costs us too much. Can you look for other providers?
The other on cost, I think there's a lot of focus on onboarding costs, but when we've been speaking with a lot of our clients, actually the pain isn't just on onboarding, but also at various other points throughout the customer journey, and the costs for dealing with those are actually incredibly high, and that could be like account recovery or high-risk transactions or other moments, and most of the companies who have become much more sophisticated at the beginning of the process still haven't fully applied that to all of their processes. And so there's a lot of, oh, as soon as anyone needs to call our cost center, actually this cost me this much. Or if we block this transaction and then they need to go through this journey or do these things. Or if they don't get a response within, say, X amount of minutes, then they might just drop off and actually not come and not apply it again, or don't recover their accounts and so on. And I think there's a huge opportunity there from the clients that we've been speaking to, the opportunity to make those flows much more automated, much more user-friendly, and much more secure through use of technology. I think the default there has still been very, very manual-based, and very sort of branch or voice-based, and there's a big cost opportunity there, as well as, of course, much better user experience and better ROI.
For sure. And you mentioned, of course, there are a few different things around, I guess, onboarding through to post-onboarding. I think, Andras, you also mentioned, similarly on that note, the notion of trying to, I guess, get the right level of security, the right level of signals for fraud and compliance kind of at that moment and not siloing thereafter. I just want to dial into that point around onboarding for a second here, because we talk a lot about that tug of war. I mentioned at the beginning of the call. And here's $1 million question for perhaps everyone here. How much friction is too much friction in that onboarding process for KYC? Where do you see companies increasingly drawing the line?
So let me kind of give you some anecdotal kind of feedback, right, from end user clients, banks, that we've seen this question kind of brought up in inquiries and other interactions, right? So first of all, this is very much geography dependent, right? So there's differences to the tolerance as to what the user will tolerate in, say, the United States versus what they would tolerate in Estonia or Germany or Japan or India, right? So these things are almost always culture and geography dependent, right? So, obviously you have a lot higher tolerance for all these inconveniences in geographies where the competition is much lower between the participants in the market, between banks, right? You might have just 3 or 4, usable banks or financial institutions versus thousands or tens of thousands of financial institutions in a country competing fiercely against each other. And then obviously the regulatory landscape, right, may also require a bank or financial institution to do certain things, and it's not their choice, right? It's like this is what the local country's regulator kind of requests, demands, and for a bank to be able to stay in business and not kind of encounter large fines and sanctions from the regulator, you have to do certain things, right? But just to answer your question, right, after the depends, clause, I would say, maximum 2 forms of identification is probably, good. Anything greater than 2 ID forms of ID is viewed as too many. Another use case or thing that really, causes unnecessary friction is basically repeating questions, right? If the customer support representative has to fill out maybe multiple forms or multiple, things during the onboarding section, and these are all paper-based, asking somebody repeatedly about, their name, their date of birth, their occupation, income, all these things, just so that you can, fill out separate siloed forms, right? and basically not remembering the previous answer that the customer gave to the same question on the previous form, right? What's your date of birth, right? You can populate that onto your all of your paperwork, right, that you have to fill out. So that is really a painful experience, right? Just same questions being answered. And then in essence, right, any kind of questions that the organization is asking that are not directly related to compliance, but are asked about, marketing preferences, are asked about, things that absolutely overstep privacy or overstep, the usual and customary set of data that are required for onboarding, and asking, like, being too zealous on, I think that's the best way of putting it, on the part of the financial institution, and getting into all these areas that they shouldn't be getting into, can be a huge turnoff, right? And it can extend the time period of the onboarding process and turn away people.
Yeah, I think it depends is a really good answer, because it does. It's culturally, it's what type of product, what's the brand of the institution that you're applying for. We do think when we speak with customers and all the end users that we've done, people do expect a little bit of friction, or some friction in some process, especially if you're doing something such as opening like a core bank account or getting a mortgage. I think no one expects that to be click through, no information, just an email address. But there is now a growing amount of services which are much more like buy now, pay later, and feel much more like e-commerce than traditional finance. And I think the expectations there then are very different, because it's much more checkout based and probably more based on the sentiment of the user at that point in time, because we know checkout drop-off is really high, versus if you actually really want to do something because it's absolutely critical for your financial life. And I think we do see that the need to be to manage that and still have your level of security and compliance requires the institution just also be a lot more dynamic in how they're managing these flows. I think one size fits all is becoming less common, and depending on which product you're offering, whether you've met this customer before, what is the level of risk that you're taking at that point in time. And as you kind of go down that journey, I think the expectation that this will be dynamic is already increasing, and many businesses are moving that way. One of the reasons we built this platform was because this is what a big ask is like. How do I automate and make it very low friction to people who I want to give the low friction experience? How do I bring in more higher friction or higher security products in the journey for the right people at the right time in the right way, but still doing it in a very slick way? I think that kind of expectation on user experience is definitely increasing. I think historically, whenever you, again, hit a high friction threshold or a higher risk threshold, the next step would be, please come into the branch, or we're going to post something to you in the post with some code which you come back and enter in. I think that those expectations are moving quite dramatically into a more digital, much quicker, and a much easier to manage experience. So that there's definitely, it's a very nuanced space, and although we know what the general trends are, I think it's very much dependent on, it depends on culture, geography, type of product, type of user, type of session.
Yeah. I would also say, asking anybody to go to a branch these days is a no-no, right? Especially for younger generations. Avoid asking the customer to show up in person at all costs.
I think the general rule is if I have to take a bus to get to my bank, I'm probably doing too much work there. But I also love Andras. Well, 2 points there. One, as someone who works in the marketing realm, I'm very sorry for asking for additional information. We're all guilty of that. I think two, Yuelin, you've really, I think, said it well there. Even traditionally, you've had cultural differences. So, for example, US compared to UK compared to Japan, in terms of, for example, how much friction I might kind of tolerate, what I might be more used to. We're now seeing another level of complexity, even within KYC regulated industries, banking, buy now, pay later, radically different approaches in terms of what the customer's willing to take on. So I guess the moral of the story perhaps is it depends, which is perhaps a takeaway I know many of our kind of viewers kind of of expecting, but also still scratching their heads at. And so in terms of practical tips, perhaps, in terms of how businesses might balance user experience with fraud protection and compliance, I know we've touched on it a bit more, but I guess Yuelin, Andras, if you could give, starting with Yuelin, like a couple of quick bullets. If you're talking to a business, what might you say? Some top tips would be to balance those two things. What would you perhaps point to?
I think my top tip to business would be to leverage all the technologies out there and build the flows and journeys and level of security that you want based on what you need. So not this is a blanket how everyone is doing it, but really sitting down and understanding, okay, what are my product lines? What are the types of, what are the customer profiles, or what are the levels of risk tolerance that I have? And then using whether internal or external platform to build that optimal journey, so that you can automate as much as you can give really great dynamic experiences, but also you can leverage the fact that the fraud compliance is converging to bring in the higher security or higher friction product lines. But I think this requires the customer really not to just expect this off the shelf, like sort of one size fits all product, but really understanding where they sit, and of course within the framework what they are allowed to do under the regulator. I think inevitably there is a bit of tension, I'm sure, depending on how a business is structured, between the marketing and user experience team, or trying to get people in, the fraud team and the compliance team. But I don't see this as sort of a conflict. It's more about really understanding you and where you are and what you're trying to achieve, and how to leverage the best, like, latest tools, technologies and platforms to be able to achieve that. I think obviously being a vendor in this space, we speak with a lot of our clients and also prospects, and that is part of the conversation, right? It is what are you trying to do? What are your use cases? Sometimes this conversation can go on for a very long time, right? We see, especially amongst enterprise businesses, they've got one or two use cases. They're like, yep, this is going to be my super low friction use case, right? Because this is the one I want to go and compete with these new digital natives. And then the conversation then goes on, okay, now here are my other journeys. Actually, I have like 20 journeys with different customers, and I'm slowly working them each. And this is a multi-year digital transformation journey, which is what you expect. Versus it's probably simpler for a one-channel digital native company who a single product even maybe. Then it's much easier to sort of know that's what you're trying to achieve. And you still, I think, need to understand though the risk profiles and how you manage that and how you interlay that with new frauds, fraud services, product techniques, and so on. But yeah, it's a bit of a know thyself and really understand and then build to that.
Yeah, so all good. I would also add, right, that this should not be a fishing trip, right? And obviously this is a platitude, but the more an organization is able to define, key performance indicators of a process, like, what is the drop-off rate, right? Out of 100 or 1,000 onboarding attempts, what number fail or succeed? And what are the reasons, right? Then, and what is the length of time it takes to onboard a customer that is just succeeded the first time, or has been going through 1, 2, or multiple rounds of additional manual kind of conversation scrutiny by a human being at the bank, right, to check the their veracity of their identity. So length of time, KPIs are pretty important in this aspect. And I would also argue that getting some surveys, right, obviously not over surveying customers, right, is also a good helpful feedback piece, right, that kind of enhances and augments this picture and adds color to it. But once you have a balanced set of scorecard, a balanced scorecard with these scores and others that I talked about, then you can actually make targeted changes to your onboarding process by changing one thing at a time and seeing, directing, a fraction or a segment of customers to that new experience, and seeing how your one change actually makes a difference in these key performance indicators. Is it in the right direction, wrong direction? Is it small? Is it large? And if the data of this, kind of alternative testing, A/B testing process indicates that the key performance indicators went in the right direction as a result of this change, then you can basically roll out this change into the production environment, and then you can start like another trial. So one thing at a time. I think is very important, just to ensure operational continuity, and relying more on hardcore, previously mutually agreed to data points, and the changes in those data points, and setting objectives, instead of listening to all the kind of anecdotal evidence, right, that you might have in a decision-making process, right, with marketing, digital business, fraud, compliance people all sitting around your table.
For sure, and I think there are perhaps two really important points, I think, between the two of you that have kind of raised there, among others. One, on your side, know thyself. Andras, on your side, perhaps know your customer. By doing those two things, understanding them, and really assessing, putting hard line metrics along that, you can be in a better place to actually look at that balancing act of KYC, UX, and fraud. And on a secret third bucket, I'd love to talk about knowing your vendor. So when you look at the conversations you're having along the lines of KYC, IDV, and beyond, Yuelin, I'll start with you. I know you'll be perhaps biased on this one, but it'd be great to ask. When you're advising companies, indeed customers like Onfido's, who to look out for when selecting an IDV vendor, what are the types of things you perhaps advise them to look into?
Yeah, this is my day job every day. So definitely, I think there's quite a few key things to account for. One, of course, is the platform itself, right? Does it have the capabilities that you need, and will it grow with you and be some form of future proofing, at least for an extended period of time, as you want to create different journeys, different flows, go into new markets, bring in the things. So key things in there, of course, things like orchestration, functionality around data, around testing, like what does your platform do? And also, does it let you bring in a lot of other signals, their own signals, like where are the best in class signals? Is it provided by this vendor? Is it ones you bring yourself onto the platform? Is it like through partnerships? I think there is a big element of platform. And then the second is regarding user experience, since that is probably one of the reasons you're going through this digital transformation. And of course, the easiest way to provide this sort of pre-built best-in-class experiences through off-the-shelf SDKs, and also flows relating to SDKs, such as like cross-device flows or other flows, if you don't, depending on what your journeys are. So having these SDKs that are really easy to use and provide a great experience. I think it is around like the sophistication of what they actually do. It's very easy. I think, as Andras said, it's very easy. There's lots of noise, lots of anecdotes, but actually, what is the performance, and is this easy to trial? How sophisticated is the tools around measurement and QC and model governance, especially as more and more of these best-in-class signals are driven quite significantly by AI. I think marketing speak is one thing, no offense marketeers, but actually performance at scale, especially around huge amount of scale, lots of different fragmentation, different countries, different experiences, anti-bias and fairness and model governance. This stuff is actually very important and isn't always at the front of the kind of pitch decks and marketing speaks. And I think especially now increasingly with the sort of standards and increasing sophistication of regulators, we are definitely seeing that becoming much more important. Like, for example, in the UK, they've just issued their trust framework for the first time, when we've been going through that journey. Of course, there's lots of stuff going on in Europe as well, in the US, although KYC regulation is still in the works, but like increasing the amount of privacy regulation as well, especially around biometrics. These are all really important standards that I think both the customer and the vendor need to have a really solid grasp on, because those are the sort of questions that people will be coming to ask.
I guess, Andras, from your side, you speak to a lot of kind of clients. So when they're asking, what do I even look for an IDV vendor? What are the things typically you might point to there?
I mean, again, I'll just give you some high-level bullets here, right? One typically would be, the richness of signals as well as data consortium data that are used in hotlist, whitelist, blacklist, right? So how rich and broad the network is that the vendor is able to bring to my table. I would also add the level of accuracy out of the box, right? So rate of false positives, rate of false negatives, right? True positives, true negatives, because this has a big impact on the customer experience. And I would also say being able to provide active and context relevant guidance to customers when they use the solution. In other words, if you're using a physical identity document verification system, right, where the person takes a picture of their photo ID and then does a selfie, the tool itself should be capable of providing, feedback to the user who may not be that, digitally savvy or mature. There's a glare on a driver's license. The angle at which you're holding it is not right. You cannot see this. Move to natural light. Move to a brighter area, less bright area. Hold this at an ankle. Use how you take the selfie. Provide guidance. So the more usable and contextually relevant guidance you can give throughout the process to a user, that's important. And I would also say, the flexibility of the workflow and being able to consume identity verification services through an API or an SDK, you could call it orchestration, I guess, but these things have been around and there's nothing that has changed right around this requirement. So that's the integration, ease of integration, cost of integration question. That's definitely important.
Sure. And I hope obviously viewers in here are kind of furiously scribbling notes right now. But just wrapping us up a moment, we've just got a minute or so left. So quick fire round. I'd love folks for you to get your crystal balls out for a second and looking ahead at the year that is for 2023. In 30 seconds or less, Yuelin and Andras, what trends in IDV, KYC, and fraud prevention will perhaps, for your view, shape the market in 2023? So Yuelin, go ahead first if you can.
I think definitely around digital identities, wallet, especially in EU, but also a number of emerging markets. And even in the US now with the mobile driving licenses, I think we'll see more of that. Probably around consolidation of vendors, really greater understanding of these platforms, what's best in breed. And then I think actually also the expectation around these platforms and what data's come, what functionality and what data and like the word of data richness and so on come as part of that. I think the standard is definitely increasing.
Okay. On my part, I would say decentralized digital identity. So being able to take this verified identity or bring your verified identity to a business and the business to verify being able to reuse an identity that has already been verified digital by some other organization and just verify that and basically not go through the entire KYC process again. Qualified electronic signatures, especially in Europe, are a big set of questions. How you're able to fit a identity verification system into that set of requirements. And I would also say in the watch list management, watch list screening side of things, so having a lot more integration between a physical identity document verification system, reading attributes off of a driver's license, passport, national ID document, and then being able to kind of check against watch list real time during the process without having to have a manual investigator look through all these things. So a lot more streamlining and consolidating processes here.
Amazing. Thank you, folks. And this isn't a test, but we can check in at the end of the year and see how we've done on latency's predictions. But with that, I'd just like to bring us all to a close. Thank you, Andras. Thank you, Yuelin, so much for your insight today and for the chat. We hope the audience has enjoyed it. So with that, I'll leave everyone to go, and we will be having a Q&A with Yuelin shortly after this. But otherwise, have a lovely day, folks, and we'll catch you later. Thanks. Hey folks, thank you for that one. Hope everyone can hear me now. We've got obviously some still attendees in the chat, so let's kind of dive right into the Q&A. As folks have questions, please do pop them in the chat. We're just monitoring this now. But we have a few that have come through, so we'll kind of use ourselves to kick that off. So I think just starting right from the top, a question for you, Yuelin. When you look at kind of what we've just been talking about, do you have any advice on how to get more people through the verification process first time, given the restrictions we've just spoken about regarding KYC AML?
Unmuted. Hi everyone, thanks very much for the questions and taking part in this webinar. So when it comes to first time success rate, which is also one of the key metrics that we build for from a product point of view, I think my actual advice is around experimentation. So we have, as a company who works with lots of different customers in this, there's a lot of I guess you can say template-based things and a lot of best practices. But because the actual reality is that everyone's customer needs and your journey and your flow and your industry would be slightly different, what I would suggest is working from one of those templates and doing true experimentation around that. So an example could be your end users, maybe from a certain geography. That geography might have certain language, use of language, different types of mobile phones, different types of documents, a different way of working with biometrics. That varies quite significantly. And it's hard to be just super general about it because it really depends on what it is. And that's just the fragmented nature. But I recommend starting from a best practice and then just doing lots of experiments on how to increase your first time verification success rate. The second thing I would say, though, is just to make, depending on what products you're using, to make sure your integrations are making the absolute most of it. So we obviously work across different things. And again, in every different product, there are particular features that increase first-time user success and particular features that may make it more difficult. So a great example is in the AML product, which I'm sure a lot of people are using, and there's a think around false positives, and actually are you collecting all of the relevant pieces of information and feeding that in so that you have less false positives that you then need to recheck. And I think, again, depending on exactly what you're doing, every feature will have ways that you can, if that is your goal, to increase first time success rate, different levers that you can pull so that overall you get the highest rate.
Yeah, and actually let's dial into that one a little bit because we have another question here around that performance piece. And so you mentioned obviously some things around success rate, acceptance rate and the like. So we mentioned performance a lot. In terms of how people can measure this, performance of what exactly? So we've spoken about a couple of things here, but how do folks cut through the noise and measure the right metrics? And I've got here, how do we measure the right things when looking at performance?
Yeah, great question. These are great product questions, are very close to my heart. I think there are two key things when it comes to performance, and one is relatively easy to measure and one is quite difficult. And so the one that's relatively easy to measure is the one we just discussed around first time user success rates, because you know how many people you've put into the funnel, and then depending on what platform I imagine you're using, you then can see where they drop off on the funnel and how many people you have at their end. And then, as I said before, you then do your experiments so that you can gradually increase that across the whole funnel. That we call it clear rate, but I think success rate, conversion rate, those are the industry terms for that. And that one is just, we got, say, 70 people through. I started with 100, my rate is 70%, and you've got your percentage drop-offs. The one that's much harder to measure, which needs to be balanced against that, is of course, did you put the right people through, and did you stop the wrong people getting through? And I think broadly we often call it fraud, but actually that encapsulates two quite difficult questions, which is what was your false acceptance rate and what was your false rejection rate? And our experience with clients is that I just think that's incredibly difficult for them to measure. We've built a very quite a complex system for managing quality control and managing our own performance. But again, that is us injecting like fraudulent documents or reported things or biometric face matches or synthetics. Like we have a fraud lab that creates all of this stuff so that we can do benchmarking, so that we can see how our performance is. of course, this is way more difficult for a client. One is because you're probably not spending your energy building 3D fake synthetics. And secondly, because you've got other components in your journey too. Believe it or not, I'm aware that our clients use this technology beyond us and have needs beyond our identity technology. And so measuring that on an applicant level across all of these different things you're doing is incredibly hard. And we know it's incredibly hard because it's one of the things that we're trying to build as the next iteration of our platform, being able to do optimization and analytics, and adding every step of products into that is quite a difficult journey. If you are interested about fraud benchmarking, though, that is actually a product on our roadmap, leveraging some of the amazing synthetic frauds and fakes that we can generate and create for testing and benchmarking purposes. Then yeah, please get in touch because it's something we'd love to talk to you about.
Amazing, thank you, Yuelin. And I think on that note, it's the same thing comes to when you're measuring return on investment as well. So when you're looking at whether or not a tool like Onfido or similars work, it's not always enough just to look at fraud. It's not always enough just to look at the clear rate on the one side. You have to really blend these things. Are we letting enough good people through? Also, are we preventing the people that might come to hurt our business through the door? Those two might not always be apparent, but you need to play them off one another when actually measuring if the thing's working for you. So don't take it at face value. Definitely dig into the details behind that.
Yeah, and I should say one thing we've learned as we have layered on the number of products, especially fraud products that we have, is that it is also it doesn't make sense to look at it in isolation, because fraud is by definition multiple different attack vectors, and if you get good at defending against one attack vector, they will come in a different attack vector. I often say, like, fraudsters are highly motivated to commit fraud, and they have lots and lots of different money to make the best things, which means that though your defense against fraud has to be multi-layered at all. So if you have, say, a really great bot detection, they'll work out a way around that. And if you have a great behavioral detection, again, we've seen like these, like, you know, farms of phones moving in behavioral ways. Even if you have a great document check, right? There's a lot you can go to with a document check, but then that's just another layer. And then you get a biometrics is another layer. We now have like all of these repeat attack vectors, repeat biometrics, repeat document attributes, repeat device, repeat IP, various others. And layering on just makes it more painful. But I think expecting to be able to capture fraud and also really analyze on an individual basis is a bit of a red herring, actually, and it's much more important to really understand your applicants through the whole journey.
For sure, and I think one of the things that actually come through in the chat is when we're looking at this, many of our customers will have local regs or indeed local need to satisfy, local types of fraud even, and some of them are going to be more global in scope, operating in 1, 2, 3, 100 geographies. When you look at how would you suggest managing different friction appetites in different geographies? How can our clients go about this?
Yeah, great question. So many of our clients are very international in nature, and I think you're balancing both the market demands and needs, and also with the infrastructure that exists. And so what I mean by that is, in certain, like, the lowest friction you can do, which is also very low assurance, is to check a piece of information against a passive database that exists. And there are certain geographies where that exists, and that is sort of the market expectation. And then if you don't match, or it's high risk, or for whatever other reason you decide to do, you then decide to go to a much more active route. That is actually how a lot of the market works in certain geographies, but that clearly doesn't extend to all geographies, because a lot of geographies don't have the infrastructure to be able to provide that passive check. And then depending on what that geography is, or many of our clients then decide to go active first, so using a document or a bio or something else to go first, because then actually you don't need to go through multiple steps, because everyone, well, that's not true, most people have a document of some sort. So it really depends on balancing the two, and therefore what configurations you can do in each of your geographies. It's a very common ask, because even within that there's actually quite a lot of nuances, because in some geographies, for example in India, a lot of people print off their Aadhaar card on a piece of paper. In another geography, I think they wouldn't be very accepting of a card that's been printed on an A4 piece of paper, but that is how the market works there. And then you can obviously also hit an ad hoc database in the back of that as well. So it really depends on which ones you're in. I do suggest though, if you're for both those metrics, both like success and conversion rate and fraud, it does make sense to optimize for that geography, because the geography is just so different in terms of all of these user needs and infrastructure. And one of the reasons we built a platform to help people be able to do that optimization.
Yeah, for sure. I guess kind of back to the conversation on the call, it depends. Perhaps is the kind of big takeaway in there, and being able to have a platform that can meet those needs. But going from the global to perhaps the super local. Obviously on Onfido, what we provide and what we look at on the webinar itself is this remote identification of an individual using a document and face, among other means. Now, diving into some specific regs that we highlighted in the call, does a remote kind of identification, like Onfido, meet the kind of, I guess, high level of assurance under EIDAS, under KYC, or is there more to it than that, for example, in relevant markets like France?
So I would like to just sort of split out the regulations that is now becoming very well formed in Europe around digital identity, so EIDAS and NETSI and so on, around AML, because that's actually quite separate directive. And there's a lot of stuff that is within the AML world that is not within the digital identity world. And that's one aspect. So on the European basis, this sort of remote identity proofing up to certain standards with certain components would be substantial or high under the EIDAS framework. As with most things in Europe, though, devil is in the detail, and it's not. I think on a country by country basis, there are nuances and quirks. So that's what we're working to. We know there's going to be a minimum set of standards, which is very well outlined in NETSI, and that's part of our some things we're already done, and also part of our roadmap. And then if there are individual interpretations on a nation state basis, then to do those for, I guess, at least the countries that make sense for our clients.
Yeah, makes total sense. Putting you on the spot at the end there with a compliance-related question. I think we've kind of come to the end of the webinar, folks, and that seems to be all the questions coming through. So with that, I'll bring this out to a close. Thank you everyone here for attending. Thank you, Yuelin, again. Thank you to Andras also. We'll send out a recording shortly after the event, folks, so this Q&A will be captured. Other than that, have a wonderful day, and we'll catch you all soon. Thank you, everyone.
Thanks all.